Hey guys, welcome back to the channel. Today we're going to be talking about one of the routes that a company can take to go from being a private business to a public company, and that is an initial public offering known as an IPO. So yeah, let's get into it. So companies have the ability to change their legal status from being a private entity to become a public company, and they can do that through a variety of different mechanisms, which include initial public offerings, direct listings, and through an acquisition, so through a special acquisition company purchasing the private business and taking them public. So there's three different routes. Today we're going to focus on IPOs, and the IPO is the most common route taken for a private company to go public. So IPOs are the most frequent route taken to change their legal status from being a private company to become a public company. You've probably heard of IPOs before in the past. They're much more common than direct listings and acquisitions by public companies. So yeah, they're one of the key focus areas for company managers that are thinking about changing their legal status from private to public. To be eligible, companies must meet specific exchange listing requirements. So they need to engage underwriters, which are basically investment banks who will underwrite the issue, market the shares to investors, and they need to meet certain size requirements and certain listing requirements depending on the jurisdiction. So whether it's the New York Stock Exchange, the London Stock Exchange, each listing venue will have different requirements, but the company needs to meet to be able to list its shares on the venue. So it involves the issuance of new shares to the public in exchange for cash. So the company, by going public, will issue new equity, and in return they will receive cash from the new investors, and that cash will be used to fund growth projects. So that's one of the main reasons why a company will IPO. It accesses new capital, which the company managers can use to fund the growth initiatives of the business. So they will issue new shares to potentially new or existing shareholders as part of the listing, and then the cash proceeds that are raised are used to fund investment projects for the company. The newly issued shares will begin trading on the local stock exchange shortly after the IPO date, with complete price and volume transparency. So yeah, once a company is listed, its shares are freely trading on an open market, which provides a share price and also information around the number of buyers and sellers of the stock. So once the company is public, there's full and complete price and volume transparency, and there's an up-to-date market valuation for the business. It has a market cap because you have a price for the company's shares by the minute, so it's updated as buyers and sellers go through. So you have a complete market valuation which is visible to investors and traders in the stock. And the listed shares will now be freely traded on the secondary market. So there's an active market now between buyers and sellers. So once the initial listing's gone through, purchasers can buy from sellers of the stock, and then long-term company investors also have the liquidity that they need to be able to sell down their positions in the company. So IPOs provide a secondary market for investors, which is helpful if investors are looking to exit their position, sell down their stock, because there's an active liquid market with price transparency, with volume transparency, that allows transactions to take place more quickly and more readily. An IPO can dilute the ownership of existing shareholders in the company if the new shares created as part of the process are sold to new shareholders. So that's a consideration. There could be dilution that takes place if existing shareholders don't purchase new shares, and the new equity that's created is issued to new shareholders. That could create dilution for existing shareholders, so that percentage ownership in the overall company may reduce. The overall size of the company may increase, but their percentage ownership stake in the company may reduce, which may have consequences if they maybe lose their board seat or something along those kind of lines. Are existing shareholders going to be happy that their percentage ownership stake in the company could be diluted? A listing creates better visibility. So a public listing comes with a reputational benefit because the firms are more visible, they release more information, so there is a reputational advantage to becoming listed. That allows for easier access to capital because now that the company's listed in the public market, they can undertake secondary offerings and issue new equity, and the greater visibility allows for greater access to debt as well. But there are more cumbersome disclosure requirements and greater costs that comes with those disclosure requirements, and also greater public scrutiny. Once you're in the public market, you're releasing more information which could give competitors an advantage or could draw attention from regulators who want to make sure you're operating fairly and operating in the best interest of customers. There's more internal costs associated with formal boards and additional reporting and audit requirements. So there are costs that come with IPO, ongoing costs. There's not just the costs of going through the process, there's the ongoing costs post-IPO that need to be considered by managers. Right, let's look at how an IPO works with a quick sketch. So we have pre-IPO. We have the company. And this is, of course, a private company. And we have the existing shareholders who own 100% of that private company. Yeah, so before IPO, we have a private company, which is 100% owned by shareholders. I think that should be quite obvious. And then post-IPO, we have the same company, but it's now a public company. And that is now owned by the existing shareholders, i.e. the pre-IPO shareholders, but also the new shareholders who subscribed to the new shares being issued as part of the IPO. To the existing shareholders will own less than 100% now because the new shareholders will have an ownership stake in the company. And then just finally, the new shareholders, as part of the IPO process, will provide equity capital to the company. So that's the trade. The new shareholders are obtaining equity, an ownership stake in a large business, but they're providing the capital that the company needs to pursue its future growth ambitions. So there you go, that's an IPO in a nutshell. It's a route for a private company to go public. It involves issuing new equity to new or existing shareholders in exchange for capital. It's the most common route taken by private companies to go public. In the next video, we'll contrast IPOs with direct listings, and I'll also do a video on SPACs as well. So yeah, I'll see you guys in the next video.